Welcome to Market Raccoon, your financial learning channel. Today, we are talking about financial risk. Here's a quick quiz. A Ponzi scheme, risky or safe? Easy. Now, the S&P 500. 500 of the most regulated, audited companies on Earth, wrapped in one of the most supervised products that exists. Sounds pretty safe, right? Then you open a brokerage account, and the label says, Risk 5, 6, even 7 out of 7, the same word you'd use for fraud. So plenty of smart people conclude the market is a casino with better marketing and leave everything in cash. Here's the thing, finance never meant that kind of risk. In everyday language, risk means the probability of something harmful happening, combined with how bad it would be. Finance means something completely different. This is the EU's official risk scale, the one printed on every fund document. It is calculated from exactly one input, how much the price wiggles, the annualized standard deviation of returns. That's it. No fraud probability, no counterparty quality, no regulation, no audits, no severity. A perfectly legal index fund and an outright scam can land in the same class. Risk in finance is volatility. The industry just kept the scarier word. And that mistranslation is why high risk reads as gamble. A gamble is a negative expected value with a chance of ruin. A volatile asset is neither. It's just a price series with wide swings. But there's a second problem, and it's sneakier. Volatility of what against what? Every volatility number is measured against fiat currency, money that is money because a government said so. Fiat, Latin for, let it be done. We treat that measuring stick as eternal. It's younger than the Boeing 747. The US dollar was redeemable in gold until 1971, when Nixon closed the gold window, and the whole family of economic charts developed a kink. Now, a reference frame has zero volatility against itself. That's not finance, that's physics. A passenger in a smoothly flying plane, blinds down, measures their own speed as 0. Your cash shows the same number every day, so it feels like the fixed point of the universe. Risk class 1, but it's class 1 for the same reason the passenger is stationary. You're measuring the plane from inside the plane. So let's step outside. I pulled 5 years of official European Central Bank exchange rates and ran the numbers. The Japanese yen, measured from New Zealand, around 10 to 11% annualized volatility. On the official scale, that is risk class 5 out of 7, the same band as a global equity fund. Measured from the US dollar, class 5 again, and the dollar gained 47% against the yen in 5 years. Two of the world's safest currencies, and holding one cost you nearly half its value in the other. Nobody puts a risk class 5 sticker on a Japanese savings account. Not because it's calm, because the sticker is printed inside the plane. There's one more blind spot. Standard deviation has no sign. An asset grinding up 30% a year and one bleeding 30% a year with the same swings get the exact same score. The scale can't tell a rocket from a landslide. It only measures turbulence. Bitcoin is the canonical example. Around 43% annualized volatility last year. Class 7, off the top of the chart. And yet, historically, people who held through a full cycle for plus years have overwhelmingly come out ahead. That's not a promise about the future. But class 7, and you will probably lose money, are very different statements. And remember who prints the measuring stick. Central banks target 2 to 3% inflation, on purpose, as policy. Even in a world where nothing real changed, prices quoted in that stick should drift up a couple of percent a year, because the stick is designed to shrink. Which makes cash the one asset guaranteed, by explicit policy, to lose purchasing power. On the dictionary definition of risk, probability times severity, a savings account held for 30 years is not the safe option. It's the certain, slow-motion loss. To be fair, volatility is a real and useful number. It tells you how rough the flight is. And that matters enormously if you might be forced to get off mid-flight. Money you need in 2 years has no business in an asset that regularly drops 30%. So here's the fix, and it costs nothing. Call it volatility, because that's what it is. And save the word risk for the things that actually match the dictionary: fraud, counterparty failure, leverage, being forced to sell at the wrong time. A Ponzi scheme and an index fund differ enormously on every one of those, and might not differ at all on a volatility band. So the next time a label says risk 6 out of 7, read it as what it really is. Turbulence, 6 out of 7. Direction, not included, as measured from inside a plane that has been slowly descending, by design, since 1971. Less catchy, considerably more honest. And if a raccoon with a candlestick tail just explained finance better than your bank did, subscribe. There's more where this came from.